And everybody, Uneducated Economist here. So this is a video that's probably going to dive a little deeper into the banking industry than your average everyday conversation. This is a Federal Reserve, what is this, from St. Louis, banking analytics, unrealized losses decrease again at U.S. banks. Now, when I start reading through this article, I think again, man, I don't remember a whole lot of banks going under. There were some bankruptcies took place, but I really don't see a whole lot of like banking collapse taking place or banking crisis that is underway. And ultimately that was going to be the case if interest rates were to rise a little. Like I think all the way back to the first Trump campaign where he talked about when Obama goes off to play golf for the rest of his life and interest rates rise just a little, that the whole system was going to be crashing down because it's one big, fat, ugly bubble. Well, it's gotten even bigger, fatter, and uglier than he could ever have possibly described back in the day. And what we are seeing today is even the case of rising interest rates, which was going to destroy the banking system and the economy. Remember, like you said back in the day, didn't do that. And what is coming from a result of it is unrealized losses are now decreasing. And now to think, okay, realized losses and unrealized loss. Like if you have a stock that you bought for $100 and it goes up to 150, you have $50 worth of unrealized gains, because until you sell it, it's not a realized actual gain. It's just a perceived one, right? Same thing with the loss. If you bought it for $100 and it goes down to 50, you have $50 of unrealized losses. So if you sell it, then you are going to have a realized loss. But until that happens, it's unrealized. Here we have a situation in which the unrealized losses from the banks when the interest rates rose dramatically has now decreased. So what happened back in the day, and I'm not talking back in the day, I'm just talking like just within the last few years, we had a situation in which that the interest rates rose dramatically and very quickly. Right? This put the banks into an incredible bind. Now, I know a lot of you remember the bank term funding program that was launched. Ultimately, all these loans that went out there, right? Because now when you think about it, a bank's asset is the loan that was created. So these loans that are out there, these things had a particular value to them. Now, when you think about loans, most people think, okay, well, it's a car loan or a house loan, but a bond is a loan. It's a loan to a corporation or a loan to a government. It's the same as any other loan out there, but it's in the form of a bond. And now this bond has a price tag to it. That price tag will fluctuate on the interest rates that are out in the economy and the demand that is being had for that particular debt instrument. Now, I know this gets very complicated to think about, but if you can understand that a bond has a price tag within itself, right? A $100 face value bond can sell for $120. It's not the face value, it's the price that somebody's willing to pay for it. Now, that price that somebody's willing to pay for it comes with an interest rate. That interest rate will fluctuate. Now, if the bond price goes up, the interest rate that it will pay will go down. As the bond price goes down, the interest rate that it'll pay will move up. Now, if you have a particular bond with a price tag that you had paid for it, and all of a sudden interest rates rise, the price that somebody's going to pay for that bond will fall. The asset that you hold is now diminishing in value. So if you had a gold coin and that was your asset and the gold price is now falling, it's the same thing that's happening with this bond. The price tag is falling. Even though the yields are rising, that's for the new investor who is buying into that bond. Now, if you own that bond, it has a price tag and that price tag is now falling. That is an unrealized loss. If you sell that bond into the market, you will have taken a loss on it. However, you can just sit on it and wait for maturity, and it will pay you all the interest rates that you were assuming at the time of purchasing that bond, and then eventually it will be paid off completely and, will essentially disappear. You will have all your money back plus the interest rates. But if you are in a situation in which that you need the money for it right away, well, it's unrealized loss. You paid a higher price for it and you're not willing to sit and wait for it to go to maturity. That means you have to take a loss for it because you're going to sell it for a cheaper price. That is what unrealized losses really mean. If they held on to it until maturity, then they would get all their money back plus the interest rates. But if they need the cash now, you got the depositors who are pulling their cash out. And now the bank needs to figure out what it is that they can do to sell an asset that is going to acquire the cash to pay the depositor. And that asset has now fallen. They are going to take an unrealized loss. Okay? Or that's going to be a realized loss. It turns from an unrealized loss into a realized one in order to sell it. What the Bank Term Funding Program did is they took that asset and they lent the bank money at full face value, as if they were going to hold it to maturity and it was going to pay off. That's what they essentially lent to the bank on that asset, saying, hey, you got that as collateral. Don't sell it because you'll take a realized loss on it. Instead, what we are going to do is lend you money on the full face value of that particular asset. And that's how they bailed out the banking system. Okay? They don't need to go and print out a bunch of money. If they have even assets on their balance sheet that have taken a loss, they will just lend the money on the asset as if it was going to maturity. And this is how they bail out the banking system. Does it work out great for them? Well, yeah, it keeps them liquid, essentially, keeps them from having to sell an asset off at a loss, keeps them in the money, right? Keeps them flowing, gets the money going out there, and essentially the operation will be successful so long as they can carry that asset to maturity, or if they are able to replace it, or if they're able to make money with other assets from the high interest rates. As the yields begin to fall, those new assets that they are collecting with the high interest rates or the high yields, as those assets start to gain value from the yields falling, that's new money coming into them. That's extra money. I don't know. It's like a profitable money coming into them. So here we have a banking situation which suffered this major pain from elevated interest rates, which essentially got bailed out from. And now they have a situation in which that the lending of these high interest rate loans out there are going to find a situation in which that the asset themselves are going to start continuing to go up in value as the yields begin to fall. Does anybody else see this? Like, it's not very big right now because not a lot of people take out loans at high interest rates, but it doesn't really matter. At the end of the day, this is new, essentially new loans that are now going to be turning profit to the banks as far as the asset value of them if it continues to drop into the future. That's meaning the interest rates. Now, I left this link down in the description. I just want to read through some of this right here. It says the ratio of unrealized losses to total securities held by the U.S. banks declined again in the second quarter of 2025 to 6.8%. That is down significantly from its peak of 12.2%. So it's almost half of what it was. You see how the banking system's getting healed? Like, a lot of people look at it and they say, oh man, it's devastating, it's getting worse. And I'm thinking, I don't think so. Under the hood, it's getting much different. Like, it's not benefiting us, the working class. For us, it's going to be a painful experience, right? But for the top 20%, the asset holders, this is exactly what they would want. Right? They would want elevated interest rates to pay on their capital investments, and they would love to see the economy being in a neutral position with those elevated interest rates. This is leading up to it. Right? Here, the banking system is getting more liquid, all right, or easier loaning capabilities, however you want to decide it. Yeah. While these potential losses are not as large as they were several years ago, they remain a risk factor for some banks, but it's diminishing. That's the point. Banks hold securities, primarily fixed-rate treasuries and mortgage-backed securities, for a variety of reasons. As liquid assets, they can be sold quickly to bolster banks' balance sheets and to cover credit losses or deposit outflows. They also serve as a source of bank income, supplementing what's earned on loans. Unrealized losses are, quote, paper losses, so banks don't lose money unless they sell the underlying security prior to maturity. See what's going on here? You see how they take care of the banking system, the bankers. The bankers always win. They will always win. There will be some banks that screw up and fail, but the banker always going to win on this because it's ever increasing amounts of new money that pour into the system. And then they will then use the excuse that it's benefiting the working class because we're trying to keep the jobs going. But the job itself, the jobs that we acquire and work and use as a career are diminishing in their capabilities of acquiring that of what we would consider to be a higher standard of living, or even just a decent standard of living, or a standard of living that is approving to what we feel is appropriate. That is diminishing ever increasingly going into the future. And it's because of the new money that pours into the system. And here it is, the banking industry is now healing. It has significant changes to the losses that they were unrealized within their balance sheet over the course of the last year. Right? 12.2% down to 6.8. This is huge. Many banks loaded up on long-term investment securities during the COVID-19 pandemic when deposits were plentiful and loan demand and yields were weak. When interest rates began rising in the spring of 2022, the values of bank security holdings declined, in some cases dramatically. This resulted in growing unrealized losses, the difference between the purchase price and the current market value of investments when the market value is lower. The failures of Silicon Valley Bank, Signature Bank, and First Republic Bank in the first half of 2023 can be traced in part to the sharp rise in unrealized losses in their investment portfolio. They knew that was coming. That right there, that's that paragraph, that thing that I just read right there. They knew that that was on its way. They talked about it way ahead of time. So many YouTubers were out there talking about get your money out of the banking system right away before the banks crash. This is what they were talking about. When those interest rates rose, those assets were going to fall in value and those banks were going to essentially become illiquid, right? They're going to start failing. So many people out there saw that coming. Very few people called out the Federal Reserve saying, well, they're talking about that, and they talk about a lifeboat scenario. I mean, I don't know exactly how they described it, but basically having the tools, but they couldn't describe those tools. Because if they describe those tools, like they didn't say this, but if they describe those tools, then the markets would then start incorporating that into the price, right? They would start pricing that into it. And so they can't tell the people what it was that they were going to deploy for a tool. They had to wait for the crisis situation to take place. And that's exactly what happened with Silicon Valley Bank, Signature Bank, and First Republic Bank. As their assets started to decline and they could not come up with the deposit money to pay back their depositors as they were pulling back the cash, this is where the Federal Reserve stepped in with the Bank Term Funding Program and started lending them money at full face value on all the assets that they had that were losing, right? That were becoming unrealized losses, or would have become a realized loss if they had sold it. They lent them money in place of that. Short-term interest rates declined in the late 2024 due to 3 reductions in the Federal Reserve Fed funds rate, taking some of the pressure off bank investment portfolios. Now, right there, right? That reduction that has now happened, it's taken pressure off of a lot of the banks, but think about the profit that is now being made by the people who are now taking advantage of that situation. It may not be much, it may not be significant in the market to say, hey, look, there is all these awesomeness that is happening on account of it, but to think that it's not taking place, it is definitely happening. Now, it's easing the pressure on some, but it's definitely profiting for others. All right, let me read it again. Short-term interest rates declined in the late 2024 due to 3 reductions in the Fed funds rate, taking some of the pressure off the bank's investment portfolios. But long-term rates, especially the 10-year Treasury rate and the average 30-year mortgage rates, have not followed suit, so unrealized losses have remained large. Very interesting little take on that. Right? And I think it's important to understand these things. Like, it's important to understand how this went down in the situation they now face on account of. Let me see. What was the other one I wanted to share with you guys? Sorry, guys, my computer's running a little slow. I'm trying to use my mobile hotspot here to activate the internet here. Okay, really interesting little bit coming out of, again, the St. Louis Fed. This is why U.S. why U.S. house prices stayed resilient while prices fell in other countries. And very interesting little piece that comes out here. And essentially, I believe it comes to the way that we set up our mortgage system. And at least that seems to be the case when you read through it. But I thought I would read through some of these things because it said essentially, like in U.S., the house prices stayed somewhat elevated, but in Canada, in Sweden, it dropped quite significantly from its peak. Like Canada went from an ultra high to an ultra low. And I'm just going to flip this around now. Obviously, you guys know that the camera is facing the opposite direction. I'm not driving a right-handed truck, right? But the YouTube app flips it. But I'm just going to show it to you here. So essentially, this right here is the most, oops. All right. This right here is the most current situation. Up above, right, this is where Canada had peaked out and where they fell to. The United States essentially peaked out, dropped a little bit, but we're staying somewhat elevated, right, comparatively to like Sweden and Canada. There's a link down in the description. You guys can check it out for yourself. Okay. So now reading through some of this, it really starts to make sense, especially on the way that we conduct our financial system when it comes to the mortgages, because a 30-year mortgage is somewhat unique to the United States, considering like some of the things that they take place in other nations and how it is that they handle their mortgages. It says, following decades of low and stable inflation, the period from 2021 to 2024 marked a dramatic global surge in inflation, an unprecedented cycle of monetary tightening. This recent monetary tightening cycle created a puzzle. Why did housing markets across developed countries respond so differently to the same global pressure? And now this is really getting interesting because everybody wanted to blame it on, I don't know, institutional money and stuff like that. Now, saying that wasn't part of it, I'm just saying there's probably going to be something much different with the underlying economic forces that are playing out that is now separating the rich from the poor. And there's no obvious separation indicator than property ownership, right? Okay. For example, during the 2021 expansion, the US and Canada experienced house price appreciation of more than 25%, while Sweden recorded increases approximately half as large, right? And that's something that we can see here in the chart. The US housing market showed remarkable resilience with only moderate price adjustments despite the Federal Reserve rate hikes that pushed mortgage rates to from 2.8 to 6.8%. In stark contrast, Sweden in Canada experienced sharp corrections, with Swedish prices falling substantially below their 2019 baseline levels. Wow. So it shot way up during COVID times and then dropped below the 2019. So now you can buy a house in Sweden apparently cheaper than you could back in 2019. That is not the case for the United States, and it's pretty much even if you look at this chart for Canada. Right? Like you could buy a house back in 2019 for about the same price you can buy it today, although the peak of the housing prices was way higher than what had peaked out in the United States. It's pretty crazy to think. All right. Where are we at? Okay, a tale of different mortgage systems. And now this, I think, is one of the key indicators, right? Like, again, institutional money had a big deal, right? It was a big deal. But this, I think, is probably the indicator right here. There is substantial cross-country heterogeneity. Lord, why is this, right? Okay, in mortgage contracts, and I'm just going to skip it. The U.S. is dominated by long-term fixed rate mortgages. More than 90% of U.S. mortgages are 30-year fixed rate contracts. More than 90% of the mortgages are 30-year fixed rate contracts. When a homeowner locked in at 2.8% mortgage rate in 2020, they kept that rate for the entire loan term, even as market rates soared to 6.8%. So a lot of people, and we all know this, during COVID, even though we had moratoriums and all that other stuff, we're refinancing, and everybody who had a high interest rate loan essentially refinanced to a low interest rate. I mean, I know on my house, I got it at 3 1/8%, right? 3.125%. That's very close to the 2.8%. I mean, it's not as good as that, but it's not bad, right? Pretty close to it. And now I can tell you, considering what it is that people are now paying for a mortgage, like I was listening to this guy complaining about, like, he even makes really good money. He works in the oil field. His wife works is a nurse or something, and they both pull in fairly decent money. And he's talking about like a $500,000 loan, and the amount that he would have to pay on it is just unreal. And he's just blowing his mind to think. And he goes, and I can pay it. And I'm like, yes, you can, right? Absolutely, you can pay. You don't want to. It's crazy to think that you would. But the average everyday person is now priced out of it. And if you can make just a little bit more than the average everyday person, then you'll probably have a shot at it, but it's going to be very, very difficult, right? This is the situation we now face because of the Cantillon effect, right? We can call it manipulation, but it's property concentration. That's what's happening. Okay? It would still be happening if it was new money pouring into the system. Our new money pours into the system, and this is the result of it. This is good stuff, guys. I don't know how many people can keep following along with this, but the documents are there, so you don't need me, right? It's just my opinion. The documents are already down in the description of this video. You can go check it out for yourself. All right. Countries like Sweden and Canada feature a much higher prevalence, good Lord, of adjustable rate mortgages. Prevalence of adjustable rate mortgages. Golly. You know, I do theater, like I do acting, man. I can't speak. It's weird. Okay. Or shorter term fixed rate products. Okay. In Sweden, variable rate mortgages are the most widespread product. These borrowers face immediate rate adjustments when central banks tighten policy. A homeowner who borrowed in 2020 saw their monthly payments rise almost immediately when the Riksbank raised rates. Or when the Riksbanks, raised rates. Canada occupies a middle ground with adjustable rate mortgages that reset periodically, 1 to 5 year periods. These differences are not just technical details, they fundamentally alter how monetary policy flows through the economy. Bang, right there. Think about the wealth effect that happens. I mean, even my house, I purchased it what was it, 4 years ago now. The amount of supposed equity that is now in it, the price that has risen is dramatic. Like it went well over 100,000 within just 4 years. Now it's dropped back substantially from that because that unrealistic rise of $100,000 plus was not real. It wasn't sustainable, and it was obviously a glitch in the system that was taking place that caused that to appear. But it's still right now significantly higher than what I had paid for it. Not that 100,000, but about half that. And that's what's crazy to think, is that I could put that house on the market for that price, take a huge reduction on the price, and still come out with a substantial amount of money on it. That is unreal to think. I was not something I was expecting when the interest rates rose. I thought when the interest rates rose, everybody was going to then have our house price completely fall out. But that's not what occurred, right? Now, it may have occurred in other countries, especially places like Sweden, but not here, because we had those fixed rate mortgages and people locked themselves into it. And now that doesn't leave a whole lot of room out there for failure if everybody is still working. And then when you think about it on top of it, if you have such the ability to sell your house or rent your house out, where is it that the foreclosures come in? Are they going to happen? Absolutely. They could happen, but the average everyday person really isn't the guy who's playing this game anymore. We learned that here over the last few years, as they aren't even into the game at all. So who is it? People who have very low interest rates and low payments comparatively to everybody else who is out there playing the game. It doesn't seem necessarily like you're going to have the dramatic drop in house prices like you've seen in other nations. It just doesn't work out the same way. And this is one of the reasons, right? Is literally because of that fixed rate that they had. Using the euro area as a laboratory, mortgage rates matter for monetary policy. Using pandemic data, my co-authors and I analyzed how countries were different. Countries with different shares of variable rate mortgages respond to monetary policy shocks in the euro area, i.e. European Union countries that use euro as their official currency. The euro area offers a unique natural experiment where multiple countries with distinct mortgage market structures all receive exactly the same monetary policy treatment. When European Central Bank, the ECB, surprises financial markets with a rate cut or hike, France, with a low share of variable rate mortgages, and Spain, with a high share of variable rate mortgages, experiencing identical policy shocks. But their housing markets respond differently based on the institutional arrangements, right? Because some people have adjustable rates and some people have more of a fixed rate. So all of a sudden, massive changes happen to those people with the fixed rate, but not so much takes place with those who have the fixed rates, right? As opposed to the adjustable rates. Furthermore, the ECB sets policy for the entire region, so differences in national responses cannot be due to targeted policy reactions to country-specific economic conditions. We identify monetary policy surprises by focusing on changes in interest rates within 45-minute windows around the ECB announcements. Within this short time frame, rate movements reflect only surprise component of policy decisions, not other economic developments. When we then use these high-frequency shocks to estimate causal effects. See how the deployment of the information? It's amazing how they use that, right? The results are striking. EU area countries with high shares of variable rate mortgages are associated with a strong percent increase in house prices in response to monetary policy. When we partition countries into high and low variable rate groups, low variable rate countries show small, delayed responses, with high variable rate countries experiencing much stronger, more immediate reactions. So those with variable rate mortgages, if they're sitting in a high position and all of a sudden they drop interest rates, all of a sudden they get a lot of economic stimulus out of that. The correlation between variable rate mortgages share and peak house price response reaches a 0.55, providing strong evidence that institutional mortgage arrangements matter for policy effectiveness. This is pretty good stuff. The lock-in effect, evidence from U.S. household behavior. One key mechanism driving the divergence in the house lock-in effect, which is unique to the fixed-rate mortgage structure. When prevailing rates rise, existing FRM is the way they call it, right? Fixed-rate mortgages. Existing fixed-rate mortgage homeowners are disincentivized from moving and forfeiting their low-rate mortgages. This suppresses the housing market of activity and limits price declines. You see, less economic activity has taken place from that. The New York Fed survey of consumer expectations provide direct evidence of this mechanism. When we examine households' expected tenure in their current homes, a striking pattern emerges post-2022. The share of homeowners expecting to remain for 2 to 5 years increased, while those expecting to stay over 10 years fell substantially. When examining households' expected tenure in their current homes, a striking pattern emerged in 2020. The share of homeowners expected to remain for 2 to 5 years increased, while those expecting to stay over 10 years fell substantially. This is precisely what we would expect from temporary lock-in household planning to stay put while rates are high, but expecting to move once the lock-in effect dissipates. And so as soon as they feel like, it's possible to get out there and flip their house for another house, they'll do it. And then you're going to start seeing more inventory show up because of that, because people will have more houses on the market to flip. The behavioral change manifests, it doesn't provide any, that's another thing, it doesn't provide any more homes, right? This is just going to start sending it up again. The prices start moving up because of that, expectation that they will be able to pick up another house. The behavioral change manifests in market level outcomes as well. U.S. housing transactions dropped sharply beginning in 2022, with our data showing about a 20% decline in 2022 and a 30% decline in 2023. That was the housing market crash in 2022 and 2023. That's when it took place. I don't know how many people realized it, but that's when it happened. Among the smaller pools of sellers, the distribution of time on market shifted markedly toward a shorter duration, suggesting that those who do choose to sell are highly motivated and priced aggressively to move quickly. The conclusion of this, the empirical evidence demonstrates that understanding institutional details of mortgage markets is not just an academic exercise. It is essential for predicting how economies will respond to monetary policies and for designing optimal policy responses during periods of economic turbulence. Pretty interesting stuff to go through, right? A lot of people just want to say when interest rates rose that everything was going to come crashing down. I mean, even Trump was saying it back in his first administration, saying that when Obama goes off to play golf and the interest rates rise just a little bit, the whole thing is going to come crashing down. It's one big, fat, ugly bubble, and it's only getting fatter and uglier. And then interest rates rose, and that didn't happen. We didn't have a crashing of the system like everybody had predicted would take place. Now, one of the reasons why we had it is because of the lock-in. People were locked in on their homes. They didn't want to give them up. They didn't want to give up the low interest rates. And if they didn't give up that low interest rates, they weren't giving up the ability to put that house on the market, which meant that inventory was going to fall dramatically. All right, let's go through some questions here. 30 minutes into this. I hope you guys enjoyed it. It's a little technical, kind of boring stuff, but without the understanding, without the knowing, without the full data of what it is that the Federal Reserve is looking at, how is it that you could possibly predict what it is that they're going to do? And then how is it that you make decisions based on their monetary policy? Like, this is how you decide whether or not you are making the appropriate decision for yourself, is by understanding what the Federal Reserve is doing with monetary policy. All right. And all the people that do nothing get paid. Calling thumbs up on the dice. I know I need to go get some dice. I need to get the dice up in here. I don't think it's because people are lazy either. They have the energy. It's just not being harnessed efficiently, so they won't give it up anymore. I am not going to give them the credit that they are doing anything to me. Like, they're not holding me back, and they're not providing me with my success if I am successful, right? Whatever it is that's going on, it's by my decision. They don't do anything to me, right? Now, they do things out there in the economy, and it's up to me to understand what those things are so that I can make that decision for myself. What is it that I need to do? Where's my network? Who is it that I need to communicate with? Where is it that I need to try and deploy my energy and effort towards? But there's no way that I'm going to expect them to do anything that's going to make my life any better. Like, they can't do that. The only thing they can do is take away from me, right? So it's up to me to understand what it is that I am in, the current environment that I am in, so that I can then use that for my best advantage, Being homeless is way better than working every day to pay off usury loans. Rooster Cogburn, I don't know, man. I mean, I wouldn't necessarily go that route myself, but I can understand where somebody else might, and then use that position in order to benefit themselves as best they can. But to just sit in that position, say, no, I'm just going to be homeless without anything, I'm not down that path, Let's see here. Keep trying to reach the golden carrot that is on the string. No. Like, I don't look that way, because that's ultimately saying, hey, they are providing something out here for you to go and try and to acquire. To me, go ahead and dangle that carrot out there. I'm going to go for something else, right? Like, that carrot doesn't do it for me. And so for me, like, I'm going to look at many different areas in which that I can get flow. And I don't think about them holding me back. Like, I think about what it is that's holding me back. It's my effort. It's my understandings. It's my ambition. That's what's holding me back. There's nothing else that holds me back other than those things. Because it's, if I don't understand how to do something, that's my fault. right? I mean, there's nobody out there who says, oh, you don't understand. Oh, man, that's that. Here, let me take responsibility for you. Okay. And let me make sure that you understand the current situation so that you don't get hurt. Like, whose responsibility is that? Is that anybody else's responsibility? No. And then when you think about it, the more people who knew how to take care of themselves, it would be that much more difficult for you to do it. Right? For you to take care of your own self, because you would be in that much competition with everybody else. No, it's a horrible way to look at it, but ultimately it's survival of the fittest out here. And if there's people out there who choose not to understand and take it upon themselves to figure it out, what it is that they need to do in order to acquire the flow, cut back on their expenses, secure a rate of interest beyond that of their occupation, and if that's too burdensome for them, and they would rather just look at the people who are doing it and saying, oh, you're just one of them, you're just wanting to be an elitist, if you can't beat them, join them, and that's the attitude that you're going to have for it, I'm imagining that you're probably going to be on the bottom side of the wedge, and it's going to be a very difficult road. Like, I don't know what to tell you. I don't like this. I don't like the fact that it's happening. I don't like anything about it, but it ain't up for me to like or dislike. That's not, that part is not really part of it. I mean, my feelings, who cares about my feelings? You know, nobody cares about my feelings. Nobody's going to come up and say, oh man, you feel bad about that? Maybe we should change the way we do things so that you don't feel bad about it anymore. I was like, who's going to do that? Nobody, right? So, you know, screw your feelings, screw my feelings. Nobody cares. What we have to do is understand what it is that's happening out here so we can deal with it. That's it, period. And it's difficult for a lot of people who see how the powers that be have enslaved the world. And then knowing what it is that's going to happen if it continues. And then saying, I would love to resist it. If I resist it, I'm going to end up in a deep depression. I'm going to end up with very little in my life. I'm going to have very little chance to be in a position of acquiring that what I need to help other people. All that stuff will slowly fade away into the abyss because I won't participate in the system because I can see how evil it really is. Like, I've lived that life. You know how hard it is to struggle? You know you cannot provide a whole lot for your family doing that? What would you rather do? Would you rather be able to provide for your family, or do you want to resist it? See, there's a difference that's happening here. I get it, man. I don't like it. I don't like anything that's happening out there. I don't want it to be this way. I would love it to be a different way. And if you want to get on board, fine, let's do it, man. You want to trade in gold and silver? I'm down for it. Pay me in gold and silver. I'll take it. I'm not going to give it up, though. Because, see, I understand Gresham's law. I understand the position that I need for me and my family. And if you hand me a piece of gold, I'm going to keep it. And you'll never see it again. Ever. All right? See, I'm willing to play the game. It's a one-way street. Guess as if it's a game, I'm going to win. Right? That's all there is to it. All right. Trump said the Dow would double to 100,000 by the end of his term. You think he has any chance? Sure. Why not? Eh? Why wouldn't it? I mean, it's just like, it doesn't really matter for you and me. We're not going to benefit from that. Right? Like, even if you put, you know, all your money into it and it goes up to, like, what is it at 50,000 now? So you dumped $10,000 into it. What are the best? So you're going to get 20,000 out of it? Like, all the move, like, if you haven't been in it already, if you're not, like, you're going to have to look for like million Dow, right? That's what you're going to want to see is like 50,000 to a million, right? A million Dow. Otherwise, why not just see it crash? Wouldn't it be much better to have it go down to like 18,000 and then you load up on that and then see it come back up to 50? Because then you would have a much better position to be in. But now you're going to dump 10,000 into it and it's going to go up to 20,000 while the people who had loaded up before are going to be like super, super, super wealthy. They're going to be beyond wealthy. You're going to look at them and they're going to be like, you're going to be like, man, how is it that you have so much up there? And I jumped in, I got it at 50, went to 100. How come you have so much? And they're like, well, we got in when it was like 6. You know? And that's the unfortunateness. If that money pours into the system like that, you're going to see an incredible amount of separation. You're going to see a huge inequality. And the chances of buying a house will be absolutely gone. There will be no way. Uneducated Economist, I am curious on your thoughts of how the markets keep ripping up. why the economic data is worse than 2008 times and COVID times. Because your problem that you're looking at is most likely you're looking at the economy in the sense of the way that it was operating back then. When you were a working class individual, you were the backbone. You were the backbone of this economy. When you went to work, you got a raise, you went and spent that money, you were the consumer, you were very, very important, right? But after that, after the great financial crisis, there was too much money. Too much money poured into the system. Too much concentration went to the top. The consumer went with it. And the working class individual, you can go to work. Go to work. Work as much as you want. Get raises. Did it help? I mean, did it help? I hear people talking about how they make more money now than they ever have in their life. Do you see that helping, or does it hurt out there right now? It hurts, right? Because we're working class individuals anticipating that our day jobs are going to be enough. We think we got a raise. We got even more raise. We got stimulus, right? Did it help? No. Because the ever increasing amounts of new money will always separate the rich from the poor. No matter how much money you get, the amount that they get will be far beyond what it is that you get, because everything that you spend goes right to them. If you are not positioning yourself into asset allocations of something, dividend paying stocks, businesses, real estate, bonds, I don't care. Like, I don't know. Like, I don't know what it is that you need in your life. I don't know how it is that you position yourself, but there's something out there that is going to pay you. You need to take your money and put it towards that. Is it risk? You bet it is. Is there a chance you might lose it? Yeah. Be good at what you do, right? I mean, be cautious. Take lessons. You know, study. I don't know how to figure it out for you. That's your job, right? That's why you do it, right? And the people who don't do it are going to hope that their day job is enough, and it won't be. So going into the future, that's what we're going to end up facing. It's just that exact thing. Yeah. The housing market will crash, but the rest will keep going up. I don't think it will. I think if the housing market was going to crash, it would have already done it. Right? It would have done it with the rise of the mortgage rates, and it would have done it with the unemployment. Right? But those things aren't necessarily happening. And now when I think about the elevated house prices, there won't be foreclosures if you can just sell the house off. Why would you foreclose on it? The only reason why you would foreclose on the house is if it's underwater. And then on top of it, just rent it out. It's a renter nation now. We're not in the same market. It's not the same thing anymore, right? The rent moratorium, the mortgage moratorium, that was the opportunity. When they, like, I was like, man, that's it. That's going to destroy the housing market right there. But then that rent moratorium came up and they're like, sorry, you don't get kicked out of your house. We're getting forbearance and all this other stuff. And here, by the way, ultra low interest rates for you. How does that crash? It doesn't. They just totally saved the housing market by doing that. All of us who were anticipating and waiting for the housing market crash, we missed out on that right there. That was it. Now, to think that there's going to be another opportunity for something like the great financial crisis, where they had a rational exuberance going into the mortgage market, where they were lending money to people who had no way of paying it back, that was a guaranteed failure. That doesn't happen today. The situation we face today is not even close to what it was that we were facing back then. It was coming to an end. The working class individual, oh shit, am I gotta go back to work yet? Yeah, I got to go back to work. Sorry, guys. I'm just going to sit out here and chat for hours. All right. I would love to hang out and just finish this discussion, but I got to go back to work. Uneducated economist. You let me know. Ninja loans. Yep, that's it, man. Gosh, keep the conversation going, man. Hit the thumbs up button. This video is going to immediately go back up. Let's keep the conversation going. Keep making the comments. And let's get this video out there. I think the data that I had shared with you today, the information that I had shared with you today coming from the Federal Reserve is very telling. All right. Once we have internalized that information, we can see the monetary policy much clearer. And how is it that we are going to conduct ourselves on account of that? All right. Uneducated economists, you guys let me know.